This video is a crypto futures trading strategy. I'm going to show you this on Binance right here and how to implement it. It's known as the cash and carry trade. This is a more professional type of strategy that hedge funds will use very often in other types of market, but I think it works great for cryptocurrency as well. I'm going to show you how to implement this on the Binance Futures Exchange and how to actually set up a trade like this, plus going over exactly what cash and carry is and why crypto is actually a really good market to implement such a strategy. This is a bit different where we're trying to take an arbitrage out of the market rather than just taking kind of, bets on where the price will go. I'll explain that throughout this video. I'll also leave a link to Binance in the description. If you trade futures, you can get a deposit bonus up to $600. So if you're trading anyway, check out that link. We'll go over to the Binance Futures page then and understand exactly what this strategy is first and how to implement it. So this is really different where we're actually trying to look around for cryptocurrencies that, number one, we can trade in the futures market, and number two, pay us a decent staking yield. You're going to need that staking yield because we're trying to take an arbitrage out of the market. We're actually trying to create a position that is what's known as delta neutral. That means we actually have zero or very, very little positional risk and directional risk. Delta neutral means that, we are not taking a long or short position on a net basis. This is how cash and carry works. So rather than just saying, I think the price is going to go up or down and essentially betting on that, we're trying to do things much more like a hedge fund would do out in the commodities market or something like that. So let's see how a cash and carry trade actually works. A cash and carry trade is a trading strategy that an investor can utilize in order to take advantage of market pricing discrepancies. It usually entails taking a long position in a security or commodity. For crypto, what we would be doing is taking a spot long position in one of the cryptos that we think this would work with. So actually taking cash and buying a long position in the actual crypto. Now that's great because you can do that on Binance and other exchanges and take that spot long position. But as you can see here, we simultaneously sell the associated derivative. What does that mean? Well, essentially we are taking a short position in the futures market with crypto. So we have a net short in the futures market as well. As you can see here, that is specifically by shorting a futures or an options contract. I'm going to show you this with a futures contract right here. So crypto actually lets us as retail investors have extremely good access to what hedge funds usually have access to. How does a cash and carry work? As you can see here, you take a long position in the spot market, and so you buy a long actual position of the crypto. Got Ethereum here, but it could be others. Then you take a short position of the exact same amount in the futures market, and you can do that with crypto. The resulting trade is a neutral delta neutral trade, meaning that in theory, our long and short positions cancel each other out. But what we also get from crypto, especially staking cryptocurrencies, is yield. We can use our spot position to go and earn staking yield. We now, theoretically at least, have a delta neutral position, i.e. no positional risk, but are accumulating yield essentially with no delta risk and price risk in that crypto. So let's see how that works. Now the trader would carry out the trade and they have to take that long position and short position. So what they would do initially is choose the asset that this works with and the amounts that they have to work with for their position. So I'm going to show you this with Polkadot because the yield that is paid through this really works well. I'll also show you an example with Ethereum because a lot of institutions actually do this with ETH because of the size and liquidity in that market as well. So let's have a look at both of them. So firstly, we need to take this long position, and I'll show you with 10,000 and we want to take a 10,000 short position as well. So how much capital do we need for this? Firstly, we go over to the market that we want to take a long spot position in. So we're going to go over to the DOT market here, and we're going to trade BUSD for DOT. So we have a 10,000 position here, and we're going to, get the position open at whatever price that we can. 5.187 in this example, $10,000. And we can see that the DOT position is 1,927 Polkadot. So 1927. Now, if you went ahead with that, you would have a $10,000 long position. You would be long 1,927 DOT. Then we need to go over to the futures market and cancel out that trade and make it a delta neutral trade, right? So $10,000 long, we now need a $10,000 short. Now with the futures market, you can easily short. So we can go over to the calculator here. Now what we want to do potentially is work out how much leverage that we want to take with this short position. Now you don't have to use leverage for this. You don't have to use leverage with futures. But of course, if you want a $10,000 short position in futures, then you need $10,000 to fund that position. What you can also do is use leverage and actually reduce the amount of collateral that you put up for this short position, which means that you have more collateral for the long position, which is good if you're trying to maximize the yield out of that long position. So what a trader would do here is look at the P&L, look at the liquidation price, go to short, and then 5x leverage I'm going to use for this example. We're going to put $2,000 in here because 2 times 5 is 10, so that makes the $10,000 position. We're now going to go over to look at our spot position and realize that we have traded and we now are long 1,927 dot, so 1927 dot, and the entry price right here, we're looking at what, 5.182. Now, one of the risks right here that you've just seen is that there is a time discrepancy between the long position that I create in the spot market and by the time that I've taken the short position in the futures market as well. And the price that you may get is a little bit different. This may actually be to your advantage. It depends when you trade it. It may be a little bit of a loss that you actually take right there on the neutral position, but we're going to calculate. Now, as you can see, the liquidation price is 6.08. This is important because we have a delta neutral position, or at least we should have, where the long cancels out the short. So if the price goes up, the long position wins and the short position loses. If the price goes down, then the long position loses and the short position wins. However, when you're using leverage in futures, there is a liquidation price, of course. And so as you can see here, it's around 6, which is around 20% away, from 5.1 that we've come in at. Now, we can increase the amount of collateral that we use. So if we increase it by $1,000, you can see the liquidation price goes to 6.5. But that obviously takes away from the amount of capital that we can put into the long position, and so reduces the yield there as well. So really, a trader is going to look at this and say, for the time horizon of this trade, whether it be 2 weeks or 6 months, where do I think the price will go? Right? If it's more than 20% to the upside, maybe he wants to put a little bit more collateral in to make the liquidation price higher. Remember, because we're in a short trade, the price going up will potentially liquidate the short if it gets to this liquidation price. Now, the other thing that we're going to do with this is we definitely don't want to get liquidated because there are trading fees and liquidation fees in here. So what you would do is go ahead with this trade, go short $2,000 collateral, $10,000 position, 1,927 dot. Then you look at the liquidation price and you put that liquidation price in as just underneath that as a stop loss order. So you would actually come out of here, you would sell short, and then you would go to the stop loss order. That's just above my head right here. You can see take profit and stop loss. So you would put that stop loss in, 5.9 or something like that, right? Just under the liquidation price. Now that gives you a breathing room in this trade where if the price gets there, you'll actually sell out of that. Now you have to manage this trade if the price does get there, but now you don't have any liquidation problems. So now what we've got in the futures market, if we can see that, we have basically a short position right here and a liquidation price, around this level. What was it? 5.9 or 6, like this. So don't worry about the take profit because that's not important. So the price can now move within this range, no problem. It can move way down, no problem, because that's great for the short position. But if it goes up to here, then you may be, stop lossing out of this short trade. Now you're not losing money because you've got that long position as well. So that's the short position side, right? Is that this whole position, this whole trade works out that you should be taking a delta neutral position, but you just have to manage this short side because this is the side that needs to be managed where you don't want to be stopped out. And if you are stopped out, then obviously what you need to do is then get out of the long trade straight away as well so that you're netting off any exposure that you have. Now comes the yield part of this strategy, and it works with staking coins or other coins that are paying a yield, right? We now have a neutral position overall, but we have this long position right here. So what we want to do now is try and actually earn that yield and then actually make our yield from this transaction. So what we do is we go over to our spot position and we're going to have to withdraw this crypto that we have into our wallet. So with DOT, you would obviously withdraw that over. Now, what you would have to do here, which I won't go through specifically, is withdraw Polkadot over to the Polkadot blockchain. Then what you'd have to do is actually wrap it over to another blockchain like Moonbeam, for example, which I'm going to show you. So we've got Moonbeam right here. And as you can see, staked DOT or wrap staked DOT, which is the token that we've just bought, paying around 29% right now as a yield. So from a technical perspective, our supposedly delta neutral trade right here, we can invest this long position into staking on the DOT blockchain. You can actually stake the DOT directly. You don't even need to use a yield farming aggregator or anything. You can just directly stake the DOT on the blockchain. But just to show you as an example here, you can get, if you have staked DOT, 24% or something like that just from that long position. So from a technical perspective here, we have a $10,000 long, a $10,000 short, a delta neutral trade with, call it 18% yield on the staking yield that you're getting there. Now you get that staking yield in DOT, and so we definitely want to be selling that as much as we can, and this price can be volatile as well. That may reduce the income you're getting from that. Let's have a look as to how that trade would actually work right here. So as you can see, you have the short entry and the net entry. So this was worked out a little bit of a while ago. So we have the spot entry here, which was 5.1979, and then we have a short entry around 5.177. So as you can see on this example, I actually made a very small loss on the net entry of that trade on the long and the short. And the position size on that occasion was 1,930 DOT. And the entry P&L, I lost about $4 on that. This is a $10,000 example. Now we can see the short liquidation in this example is around about 6.2. And our stop loss is a little bit below that. So we're having a stop loss around 20% away, 1.2, 20% away from our entries. So as long as the price doesn't go up 20%, we should be good. Now we also have something called funding in futures. Now, funding can be negative or positive. If you have a short position, you may actually get paid money to take that short position as well. And so you may actually be earning a little bit of extra on top just for having that short position. Although sometimes if you're short, you actually have to pay funding as well. That's how futures works with crypto. And so you can see that right now on Binance, the funding is actually around 1% per month. Positive for shorters. That means we're actually getting paid around 0.9% per month to actually short DOT on their position. So we're actually earning that already. As you can see, the net position here, we have a short position of around 10,000 and the collateral that we posted was 2,000. We have a long position of around 10,000. That long position in DOT in the coin is 1,930. Now we can see the yield that we're getting. So the spot yield on our DOT that we saw on Beefy, that yield aggregator, is 18%. It was actually a bit more than that, but I've taken it down a bit just as an example. Now the spot yield per month would be around 1.54%. Let's call it 1.5 something percent, right? Because that's the yearly figure, an APR. So we want the monthly figure here at 1.54. Now we have funding here that we're currently getting paid almost 1% per month, 0.9 per month. I've taken this down to 0.5 and just cut it in half because over a month you may get some funding and you may pay some funding. Also, I've put a cost in here of 0.2%. Trading fees and other costs, are going to eat away on the way in and on the way out. So that is coming out of that 1 month yield. I've done this on a month basis. The total is 1.84%. That is after fees and everything. So, let's call it 1.84%, which on a $10,000 position is $184. $25,000 is, over 400, and then a 50,000 position, almost $1,000. Now, potentially what you've got here is a delta neutral trade with yield getting taken out of DOT. Polkadot is a bit risky and volatile, and the blockchain's a little bit difficult to use and get into. So let's look at an example with Ethereum as well. It's exactly the same thing. So we need to take a long position in ETH. So we go to the ETH BUSD market. We take a $10,000 position here, and we see we get around 7.7 ETH, 1,291. Now what we need to do is take that short position again. So we can look at the calculator. We can go liquidation price. we want a short position. We want to go down to 5x right here, put in $2,000. What is the amount of ETH right there? It's about 7.74, something like that. And then the entry price, let's call it 1280. Calculate, you can see the liquidation price is 1,500 here. So you've got potentially a delta neutral position in ETH. And then obviously withdraw that Ethereum from Binance, go over to Ethereum and switch it into a pool, right? You can either stake it for staked ETH, which is yielding around 4%, or you can put it into an LP, which has, low risk, low impermanent loss. And we can put that on Curve Finance, and we're getting around 6% right now on staked ETH. So again, you've got very little positional risk and delta risk here. Then we go over to see what that would be. And as you can see, I've just done this example here. So we have a short position of around 10,000, spot long position of 10,000. You can see the yield right here is lower. So the spot yield per year is around 6%. After the funding costs and everything, you're getting a monthly around 60, 65 basis points, way lower than the dot, but you can trade with much bigger size. The market is way more liquid. The spreads are a lot tighter. And as you can see, if you had like a $50,000 position here, you're making around about 300 a month. And you may say all of that effort for a few $100 a month, but what you are theoretically doing is actually reducing risk to a very, very minimal amount, right? So that is what an arbitrage is. It takes a bit of work, but what you're trying to do is actually earn arbitrage yield out of the market and not just taking a random risky delta position in futures, hoping that the price goes a certain way. Is this really worth the bother? There are many risks with crypto. So we've got the funding rate here. If you have to pay funding a lot, that's going to take away from all of your profits. Although it can actually work out for you as well. If you've got it per month, it might be 0.5% or so either way. Liquidity risk, certainly for lower cryptos, right? The liquidity is just not there for a lot of them, so it may not work out and may not be worth the bother. Blockchain and platform risks in terms of using wallets, and also platform risk that, you want to use something like Binance or something where, they're going to be around for the time of this trade, right? App and rug risk. If you're using protocols that pay a higher yield, then they're inherently more risky. And so the least risky is to stake ETH directly on the blockchain, and you're going to get lower yield for that. So yield is commensurate with risk. Execution risk in terms of, can you actually execute the trade, right? Can you go long and short at the same time and there not be a crazy price discrepancy? And on the other side as well, if you're using leverage right here, can you manage this position? This has to be actively managed. This isn't set it and forget it and away, but it has to be actively managed as a trade. Something with staked ETH specifically as well for right now as making this video is definitely liquidity risk. Now, staked ETH is still locked up in the Ethereum staking contract, and that means staked ETH can often have price discrepancies from Ethereum. And if that does happen and you need to get out for some reason, that could be a part that actually takes away the yield from the strategy. Now, I believe that in March 2023, staked ETH becomes unlocked. And so that potential risk for that strategy goes away completely as well. So yeah, with every asset that you have, there are definitely many risks that you have to factor in before taking out, any positions, and especially leverage positions as well. It's not a particularly glamorous trading strategy, but it is a potential arbitrage and something hedge funds always do look at as well. If you want the bonus on Binance as well, link in description for that. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.